beauty, and it was a beauty, was a bank foreclosure. Okay, so the bank had it for, I don't know how long, maybe a year. And banks are really, really good at property management. Did you know that? They are amazing. They're so on top of it. So with their so on top of it-ness, they had essentially created a situation where the building was in physical disrepair. They didn't even know who was paying. Some people were paying. They didn't know who. They had rents coming in. They didn't track who they were coming in from. There was definitely a lot more humans in the building than there were rents coming in. So this is what we were dealing with. So naturally, I mean, what would you expect to get if you're getting a building that has all these, problems and challenges and we don't even know what it is? What would you expect as an investor if you're going to get that? It starts with a D. Yeah, a giant discount. Absolutely. Well, that is essentially what we got. So we got the building for $210,000. This is 26 units. So we got the building for $210,000, but understand most people, I mean, you can't go get bank financing on a building that has, 7 or 8 paying tenants out of 26. No bank is going to lend on that. So the amount of buyers that were available for that particular property were a lot fewer than would be for, a regular single-family house that was a foreclosure, where there's a line of people making offers on REOs, like Jeffrey was talking about, right? They're so competitive. Well, in this case, it wasn't competitive because it was going to be a major turnaround. It needed about $45,000 of just basic renovations to get the units livable that were empty. So here are the numbers. So purchase price is $210,000, and then the rehab was $45,000. Now, this next piece I'm about to tell you is very rare. I have very rarely seen it. My hippie filmmaker friend just has this amazing ability to talk with banks. And they actually got the bank to carry $80,000. The bank that foreclosed on the property actually ended up carrying back a note for $80,000. It doesn't happen that often, but the lesson there is if you don't ask, then the answer is automatically no. So we are all in $255,000 on this deal, right? 26 units. Okay, when I came in and started working with them, the rents that were coming in on average, so for the first 6 months, I looked back at February through July 2010. The rents that were coming in were about $8,000 a month. And then the average expenses of the building for that period of time was $7,150. Okay, so I mean, not much room for margin there. I mean, they didn't have very much of a loan on it because this particular guy brought in an investor partner, so it was mostly cash. But there was still an $80,000 loan from the bank. So it didn't leave them very much to work with. So at the end of the month, there was $850 left. All right, so we're going to annualize that because we want to look at what I want to show you is what happened with the value of the building over the past 18 months. So if we extend that out over 12 months, it's $10,200 a year of NOI. Okay, so $10,200. So in a market where 10%, this is in Detroit. Detroit is easily a 10% cap rate market, so this actually samples valid here. What would be the value of the building based on what we learned before about cap rates? $102,000. So why did Robin buy this building in the first place if it was only worth $102,000? Because you can improve the expense rate. One, you can massively increase the rents or the income because only 8 or 9 people were even paying. Actually, it must have been more than that. It must have been more like 12 at 8,000. Okay, but this is what we were dealing with for the first 6 months. We essentially went in and put in every single system to do a turnaround with. And if I had done this with someone's single-family portfolio, I don't know if we could have made the same effect, and it definitely would have taken longer. All right, so if we have $102,000 was the value. Now, I went back and I looked last night at the financials for the building. Over the past 6 months, so this February through July, compared to last February through July, we are up to $11,500. Now, in this particular case, we are actually not making, the focus was not expenses, because the expenses weren't out of whack to begin with. The expenses were actually okay. So this has strictly been a top-line focus. Like, how do we get the income up? And that's where the potential was. So, expenses are the same. Okay, so what we're dealing with the last 6 months, so February through July, this is average. Some months were higher, some months were lower. We raised the net income from $850 a month to $43.50 a month. Okay, but now we have to annualize that, right? We get out 12 months. That becomes oops. Don't look at that. Don't cheat. Nope, no cheating, guys. Now the building is producing over $50,000 a year in income. So when we started, the building was producing $10,000 a year. So we just got a $40,000 raise, a little bit more than $40,000. Okay, in a 10% cap rate market, how much of an increase would that be? Yeah, like 400,000. All right, so what the value of the building becomes, a 10% cap rate, is 522,000. Now the really cool thing is that in the month of July, when I was analyzing their financials, they actually increased their rents even more. I'm not going to go into this because in general, I'm very conservative with my investing, and I will always look at an average, just because we have a high rent this month. But rents have been slowly increasing, and in the month of July, the rents collected were $12,500. Wow. So if we did that, we've literally added an extra $1,000 a month, which bumped it up a lot. But let's just look at the last 6 months. So essentially, the building was purchased and rehabbed for $255,000, and 18 months later, the value of the building, and this is a real value, it's not pie in the sky, and a 10% cap rate, that is in line with that market, the value of the building is $522,000. So that's what I said, the D word, dang, wow.